6255 Breakfast with Stephen Cenatiempo on 2CC.
You know, there's always a lot of talk about interest rates, and what the official cash rate is everybody's focus. But that rarely actually translates to the real life experience of Australians, whether it be what they're receiving on their savings, which is always considerably less, or what they're paying for their mortgages, which is often considerably more. If you're on to personal loans and credit cards, it's exponentially more than that. But why are they all very, very different? And I've been looking at this a bit lately, and I've got to say, I like to think I'm relatively informed and intelligent, and I can't work it out anyway. Chris Foster-Ramsay from Foster Ramsay Finance is going to talk to us about this morning. Chris, good morning.
Good morning.
I often see, we talk about the official cash rate, which bears very little resemblance to what you pay on your mortgage, but then we have this concept of comparison rates, and that's not actually what you end up paying. How does anybody navigate this and know what the hell's going on?
Oh, well, it's about comparing apples with apples. And I think that, you've just got to use, whether it's a comparison website or whether you speak to someone like me or one of my peers about, the circumstances that are suitable to each individual. They're just so different, and there are so many layers that come into it.
Well, you put a list together of things that we really need to look at. And, a lot of people would be looking at, okay, well, old mate told me he got a 6% interest rate. So-and-so told me they got 5%. I'm being charged 8%. What is driving this? Talk us through those 6 points that you've identified.
Yeah, sure. So there's a lot of this going on around at the moment. And then it comes down to a couple of things. And they basically revolve around how much equity is in your home, whether it's an owner-occupied or investment property, what your repayment history has been like, and whether it's principal and interest, interest only, or something similar to that. So they all have a bearing on what the actual rate delivered is.
So when it comes to equity, obviously, so the bigger the deposit you got, is that going to influence your interest rate?
Yeah, correct. So it's basically what we're talking about here is that the difference between what the home is valued at and what the value of the loan is at, and that difference, the bigger that gap, chances are the more power you've got to be able to negotiate an interest rate.
Okay, so if you're downsizing, for instance, or you're moving from one home to another as opposed to getting into the market for the first time, you're probably going to be better off.
Yeah, correct. Yes, correct.
Now, you've also said that homes deemed higher risk attract higher interest rates. What deems a home higher risk?
Well, it can be a couple of things. It can be around, such as like a large apartment building that's, got 50 or 60 apartments in it compared to a standalone home, like concentration risk. There can be other things that overlay as well, such as flood risk, bushfire risk, etc. And what I mean by that is that it's the lender will, from time to time, determine the maximum lending level for that particular area with those overlays.
Now, the other thing that always surprises me is that owner-occupied loans typically get a better interest rate than investment loans, which always surprises me because an investment loan generally has I won't say a guaranteed income, but you're at least going to get rent from the investment property that is going to mitigate the risk, I would have thought.
Yeah, that's right. And it was never the case. I mean, if you go back, it hasn't always been the case. If you go back, 10 years, they were priced the same. So you could have, it didn't matter whether you were having an investment loan, owner-occupied loan, or interest only component to that. That was all about the same. But given the changes at the APRA level, they've been, lenders have been told that they need to price the different loans accordingly.
Yeah, okay. Now, obviously, you talked about principal and interest repayments are cheaper than interest-only repayments. Obviously, because you're not paying off any of that principal, the banks are going to deem that a higher risk loan, I would have thought.
Yeah, look, it comes down with that sort of stuff. Comes down to the actual investment strategy. I mean, there are some people that don't want to pay off the principal of their loan, so they look at the interest only option. However, what we see a lot of the time is that there's now not a lot of difference between an interest only repayment and a principal and interest repayment, and there's design in that by lenders who want to try and discourage the behaviour. So, interest only, just because it's cheaper in cash flow, doesn't always mean that there's that much difference between paying the principal down and just paying the interest bill.
And from your average mortgage holder's perspective, somebody who's an owner-occupier, you're better off paying off your principal as quick as you can, I would have thought.
Absolutely, yeah, for sure. I mean, we see so many people, and industry-wide, I would say at a high level, we see so many people paying down their own occupied loans through additional repayments or weekly repayments to make additional hits into the principal, and using things like offset accounts and redraws to really smash that debt down.
Yeah, okay. Now, the last thing is, if you're self-employed or you're a small business owner, verifying your income is a lot harder than, if you're a PAYG or whatever it's called, PAYG, PAYE, it used to be called, you get a pay slip from your employer, and that is evidence of how much you're earning. But if you're self-employed or run a small business, it's not that easy. What impact does that have on your ability to get a decent interest rate?
Yeah, so and it's not a conversation for today. It's definitely another day's conversation. But there are changes around the verification methods of self-employment, and lenders are becoming a lot more commercial around that. But I would say that in terms of the interest rates that apply to self-employed people, there's a very big difference between using financial statements and information that's verified, that comes from your accountant, and supported by ATO returns, compared to just declaring your own income because the paperwork's not ready, or it's for whatever reason it's not done. So there's a big difference between that when it comes to interest rate based on risk.
Preparation is key.
Absolutely, yes, for sure.
Chris, always good to get your insights. Thanks for your time this morning.
Thanks so much, Stephen.
Chris Foster-Ramsay, finance and money expert from Foster Ramsay Finance at 6:17.